Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is David McAlvany, who's president and CEO of the McAlvany Financial Companies. He's also one of my favorite money managers, and I really have not missed a podcast any of the weeks he's released it in the last 3 years. So I'm very happy to have him on today. Thank you very much, David, for coming back and being a returning guest on a Wall Street from Main Street podcast.
Good to be back with you.
Great. Now, David, let's jump right in here with the questions. We had the election here, and the markets kind of sold off, except for, I guess, gold and silver, which have kind of showed some resiliency. Do you think the stock market is overvalued at these PE ratios, and why hasn't the stock market crashed already?
Overvalued would be an understatement. We've gotten here on decent profitability and decent earnings, but I think you've basically priced in perfection at 13 plus. So to see it slip below those numbers now, really no surprise as far as we're concerned. As asset allocators and investors and hedge funds look at 2013 and say, okay, taxes are going to be a much, much bigger issue in the next 4 years, and we've got to decide what we want to hold for a long period of time. And so that is, I think, a major question in professional money managers' minds, but also in your average investor who's looking at perhaps a high dividend paying stock and saying, well, I'm not going to get to keep very much of it, or not as much as I was going to, with taxes increasing considerably there as well. So capital gains, an increase in dividends tax, these are things that will continue to pressure the stock market. But I think you're also dealing with an economic backdrop that's just not supportive to 2013 putting in better numbers. The earnings for the S&P, many analysts still think it's going to be over 100, maybe 110, 115, and we would see actually earnings for 2013 slipping. That's really not priced into these markets.
Yeah, and I didn't see any revenue growth really from the earnings season. I mean, some of the stuff was priced in, but what really worries me is just the margin compression, and especially from these global companies, the companies that operate in the developing countries with the dollar pegs and stuff like that. They're just having a really tough time controlling their costs, because the way the world economy is set up now is that when the U.S., we're essentially on a dollar standard, I guess, for lack of a better term, and when the U.S. prints money, when the Fed does a quantitative easing or stimulus program, that inflation gets exported, it works its way into the value chains of other countries, and then that creates inflation in the value chain, and that hurts the profit margins of companies.
Right, so your major companies around the world, they're going to continue to face that. And we saw Apple come up with some very creative accounting by keeping profits overseas and not repatriating. Those kinds of things will be the only way that major companies are dealing with margin compression, higher taxes, greater regulatory uncertainty here in the United States. There will be pockets of profitability for them. They're just going to have to do their own sort of sequestering of funds, so to say, to keep their mothership alive.
Yeah, and I see retail money. I just don't see retail money, especially the mutual fund money. It's not going into the stock market. It's leaving the stock market as rapidly as it possibly can, in my opinion. And you just see a lot of retail money, which is the quote-unquote dumb money. It's flowing into the bond market and the treasury market still. And then in terms of the companies there, in terms of the actual stock market, Wall Street, with all these programs that the Fed comes out with, I mean, they're not really saving Main Street and the real economy. A lot of that money is still being handed over to the hedge funds, to the Wall Street speculators, and then what they're going to go in and they're going to go buy stocks with dividends, right? Or they're going to go buy bonds with a yield and with the free money from the Fed.
You're exactly right. In terms of concern about where the retail investor is going, out of the frying pan into the fire, moving into the bond market at this particular stage, you look at the current yield on junk bonds, for instance, and people are yield hungry. People are frustrated that their deposits at banks are not paying them anything, and so they're looking at their total portfolios and increasing risk at a time when they should be decreasing risk. As painful as that is to adjust your monthly budget so that your cash flow in and out matches up. But that's not what the retail investor is doing. The retail investor is stretching for yield, getting into riskier and riskier credits, and putting themselves in a very awkward position. If for any particular reason we see a reappraisal of risk in the Treasury market, and that could be between now and the end of the year just on the basis of what we see with the fiscal cliff and sort of non-resolution there. Another downgrade to U.S. debt, and you could see, again, the ripple effects across the fixed income space. The retail investor really doesn't appreciate the kinds of risk that he's taking today.
I completely agree. And the bond vigilantes have just left the U.S. alone for the most part. I mean, they've gone into Europe. They haven't gone into Japan yet. Let's transition then to your view of the world macroeconomic situation. Do you see that the world economy is dealing with worsening stagflation, or do you see things a little differently?
Slowing growth across the board, and this is really where you take a 30,000-foot view and say, what is the big picture? What's been happening not just over the last 2 or 3 years, but over the last 30 or 40 years? We've seen total credit market debt expand from $5 trillion to over $55 trillion. That kind of credit expansion over a 25 to 30-year period drives asset prices bananas. I mean, whether it's stocks, bonds, real estate, and being at the end of a major credit cycle like that, you can expect to see, and this is of course where your hyper-deflationists get very concerned, something of an unwind in the debt markets. There's just been too much debt created, too many IOUs that are out there, and not all of them will be paid back. So where will the pain be concentrated? That's certainly a more nuanced question. But with that amount of credit expansion, and it's not expanding any longer, yes, you're going to see a slowing of growth. Yes, you may even see a contraction of growth globally, and that does have, for us, some real implications into not only the U.S. economy, but, again, global macro picture here. Could be Brazil, could be China, could be India. Certainly we've already seen Europe put on its heels, and they still are not out of the woods yet.
Yeah, and here in the U.S. Specifically, I see even if Obama didn't get reelected, I was going to see higher direct taxes because what the Bush tax cuts were going to not be extended. So you're going to see higher direct taxes on capital gains and investment, higher direct taxes on the private sector, on the real economy, on Main Street, and then you're going to see worsening inflation. And then on top of that, because of the worsening inflation, because the U.S. government is running massive budget deficits, you're just going to see capital and resources misallocated on a never-before-seen scale, in my opinion.
Yeah, the difference between inflation and stagflation is pretty important because most people assume that inflation is driven by an increase in wages, and that's exactly what we have lacking here. We don't have an increase in incomes. We have stagnant wages, even while we're seeing the costs of our basic services and goods on the rise. That's what's squeezing the average family, the average middle-class person, and it's particularly painful. There's sort of a cumulative effect in terms of the demoralization of the middle class or the consuming class in that context. Stagflation is with us. You're right in saying, okay, we're somewhere between an inflationary and a deflationary outcome, but it's monetary policies, lack of real energy on the fiscal side that has us sort of stuck in the middle here. Again, stagnant wages and increasing prices. It's going to be tough to bear, I think even more so as we move towards 2014 and 2015.
Yeah, I completely agree. And as we were talking before we started recording, I see the world macroeconomic situation, but especially here in the U.S., I see the Fed trying to keep things in between the two poles, the two bimodal fat tails. They're trying to keep things from a full free market forces debt deflation where, you have a 2008 Lehman type event where you have that magnified, and then you have, on the other end, you have the runaway hyperinflation type scenario, and everything else I view in between as just a different degree of stagflation. So I think the Fed is pretty happy at keeping things in that stagflation sweet spot, as I call it, and then when things move too much towards one side of the pendulum, they try to just move it back towards the other.
And at this point, the Treasury is pretty happy with this as well, because to the extent that the Bureau of Labor Statistics and other statisticians can continue to fudge the numbers on some pretty critical variables or inputs, we're understating the CPI by at least 1%. At least 1%. If you understate your measure of inflation, you overstate GDP. And the real beauty of understating inflation and actually running a higher, maybe even 2%, 3% higher than stated inflation, is that if you do your time value of money calculation, this massive stock of debt that we have to pay off, whether it's the current of $16 trillion, the unfunded liabilities of close to 70, or on a GAAP basis close to $130 trillion with an all-in number, you can cut any of those numbers in half over a certain period of time if you just increase the inflationary variable in the equation. So I think the Treasury's happy with this. How are we going to pay off our IOUs? With cheaper and cheaper money. We've got to be able to do that without upsetting our creditors, which means you can't really run full throttle. You could take care of it very quickly if you ran into a hyperinflationary scenario and just paid everyone off with worthless currency. Well, they don't like the destabilization effects. They don't like the unintended consequences of a super or hyperinflationary scenario. So a controlled level of higher than stated inflation, that is, a way to eliminate and alleviate the pressure of debt, which they're very fearful of. We know that Bernanke doesn't like the idea of a debt unwind and being in a deflationary vortex. So, what are the tools that he's using? I think you have complicit in the mix not only the monetary tools, but the as they've said, lies, damn lies, and statistics. Well, we know the statistics are all three are sort of at this point fairly opaque. But we can intuit and we can add up the numbers ourselves and see this is actually a way out for them. It's a way out for them. But it does put the average person in the middle class back in the crosshairs. Someone who's saved $100,000, $500,000, $1 million towards retirement and was hoping that they could get an income from their assets is being pressured into a very awkward position, again, with inflation taking a bite and with tepid rates of return available without taking outsized risks.
That's completely right, and the Fed's going to force them to become speculators just to maintain their standard of living, or at best maintain their standard of living. And you mentioned about what the Treasury wants and the goals here, and it starts with Ray Dalio's 30-page paper about the beautiful deleveraging, and that's basically the blueprint that's being implemented, where the nominal GDP growth is higher than the CPI inflation rate and the nominal interest rates, and you just keep running the things like that, and you use financial repression, and they might eventually have to go get people to sacrifice a certain amount of their money in their 401k or IRA in order to fund some of the Treasury deficits if the people who are running dollar pegs get out of this. But I don't think it's going to end well. I think this is a plan assuming the Fed will have to take more and more intervention of the markets, and the market will just go along with it. The Fed is assuming, incorrectly in my opinion, that it can control inflationary expectations, that it can keep dumping gasoline on everything, and it can make sure no one lights a match.
Well, and just to be clear, repression is something that I think maybe a lot of folks out there don't fully appreciate, but it's basically a redistribution of capital. If you were supposed to receive for investing and taking some risk in the marketplace a 2% rate of return, a 3% rate of return, a 5% rate of return, through repression, essentially there's a rechanneling of money that should have gone into your pocket into either a subsidy factor for the government or directly to your large banks, and that's essentially what you're seeing. Is it's a different kind of theft, and it's legal theft, but it is all the same theft.
Yeah, I completely agree. And let's change topics here to Japan. You have recently put out very in-depth videos with your insights and analysis of Europe and China, but I would like your thoughts on Japan. Is Japan the next black swan? And is Japan looking at a massive haircut for their sovereign bondholders and or a massive currency devaluation in the yen in the near future?
Yeah, I think one of the interesting ideas is seeing the yen come down considerably in value, and we've seen very little growth in Japanese equity markets for many decades. It's now several thousand points off of its all-time lows, or at least multi-decade lows, but it really doesn't have any impetus to go further until you see something collapse in the yen. So, the yen down, Japanese equities up, that could be a very interesting scenario over the next several years. When it comes to their demographic issues, it's a bloody nightmare. So looking at the Japanese debt market, it's very reminiscent of our own. We just have too much debt, and we haven't really figured out, other than through repression and inflation, ways of dealing with it. They haven't, and in fact, they're a lot further along in terms of sort of acute risk in their bond market. Again, a lot of that comes back to a demographic. It was just about a year ago that they went on an advertising, a PR campaign for Japanese government bonds, and were trying to appeal to young male investors, because what they're noticing is that while they had a captive audience with an older crowd of savers, they're losing that. They're losing that audience altogether, and there is no way to convince a young Japanese saver to put money into the bond market. So the Ponzi scheme in Japan is coming apart because they're running out of new players, running out of fresh meat, if you will. And they've actually gone so far in this PR campaign to say young Japanese women are looking for young Japanese men who are investing in Japanese bonds. I mean, it's kind of the new sexy, the new masculine, the new, really impressive masculinity is someone who's investing in Japanese bonds. Yes, it's critical when you're playing the sex card in the process of selling bonds. I think you are getting pretty close to a real problem.
Yeah, I've never heard that one before, and we could spend a whole podcast talking about Japan. I mean, we really could. We could spend 45 minutes or an hour talking about all the problems with Japan. But in terms of what's really going on there, you have a demographic problem, like you said, and then you have a bunch of people literally for the last 2 decades who haven't made much investing income. The people there who have made money in Japan have held it in cash. They've held it in JGBs. They won't touch Japanese stocks, like you said. They won't buy real estate because the real estate there, it gets knocked down and it gets rebuilt with brand new technology, so they don't value the houses. So it's just they've spent a lot of money in their collectivist culture, I guess, investing and trusting the government and allowing the government to continue to run these massive deficits and then misallocate capital. And I hope the U.S. does not turn into Japan, but I don't think it will. I don't think we have that long. I don't think the U.S. is going to have these problems for 20 years.
Yeah, it will be interesting. I mean, one of the key differences in terms of the Japanese government bond market and the U.S. government bond market is U.S. investors, they can't be shamed into buying things. I mean, we either think it pragmatically makes sense or we don't. Now, the government could force our hands through some sort of a 401k prudent man allocation, or more probably not through 401ks, but pension assets and other more opaque retirement funds, again, pension assets, insurance company assets. They could require a 15% holding in treasuries, a 20% holding in treasuries. And that's really where we're likely to see in the U.S. any stability long-term in the U.S. bond market will be on the basis of conscripted capital, whereas in Japan for years it was just you're shamed into supporting the government, and if you didn't, you really weren't that good of a person. So there's a different cultural dynamic, a very different cultural dynamic, and it will be more at the point of a gun, proverbially, that the U.S. investor supports the bond market.
Yeah, I completely agree. I think people here in the U.S. are waking up much, much faster than people in Japan, and I think there's a large, especially because of the internet and YouTube and your people, who are putting out great content and podcasts like yourself, and you're doing a great service for the community and waking everyone up. I have one final general topic here for the interview, and it's concerning the commodities bull market. We've had a hard landing in China. Is the commodities secular bull market over, or has the bull market become more discriminatory for only specific commodities like precious metals, food, or agriculture and energy?
Well, I would say discriminatory is the right approach. When you look at commodities super bull, just understand that underlying that are certain growth dynamics, and if those growth dynamics change, you really are thrust back into the basics of what makes prices move, supply and demand. So, we've had record crops of sugar. It's no surprise that we're over 50% down in the sugar market from last year's peaks. And, that's simply a supply and demand issue. On the other hand, you look at wheat and you look at corn and you look at soybeans, and those prices have been soaring on the basis of weather patterns in key geographies, and there's not enough supply, and demand is pretty constant because these are basic staples. So, again, supply and demand are determining the direction of these markets, and, when you look at industrial commodities, for instance, much more tied to growth trends, development trends, infrastructure trends, there you see slowing of global growth and having a major negative impact. So yes, you have to paint with a much finer brush stroke as you look at the commodity space. I think gold and silver are your standouts, gold being surely the best commodity to own, in my opinion, not from the standpoint of growth, but from the standpoint of asset preservation, which ultimately helps you grow your assets. You get through a rough patch and have capital to redeploy productively, and it becomes a very compelling story. So, chasing returns, just like the retail investor chasing income yields, you don't want to always take the greatest amount of risk for the greatest amount of return. Sometimes it makes sense to just settle for less. That would be my position, gold versus silver. Silver's compelling in terms of its value today at a 54-to-1 ratio to gold. It will ultimately outperform gold in fits and starts. But again, these are assets that are being essentially remonetized. During the bear market years of the 90s, 80s and 90s, these metals were treated as a commodity, and they're reasserting themselves as currencies and being acquired as such both by individual investors and central banks. So those two key consumers, if you will, of the metals, investors and central banks, have changed the character of those two metals. Nothing has happened to change the character of wheat. It's still going to be, if bread's too expensive, then people will come up with something else to eat. But that doesn't happen overnight. So demand is more or less constant, with supply being your primary impact in terms of price, either up or down. With gold and silver, it's fascinating because you have supply inelasticity and growing demand with central banks looking at massive amounts of dollar reserves, which they've developed through the last 10 and 20-year period, and they want a different monetary alternative. They looked at the euro. They've shifted as much as 26% of their reserve currency assets into the euro. But honestly, in the last 3 years, can you look at the euro and say, it's all of our hopes and dreams, and we want to bank all of our tomorrows on this particular outcome? And the answer is no. So if it's not the dollar, if it's not the euro, where does the average central banker go to have a few of their current dollar reserve assets placed? And that's where we're seeing tonnage taken off the market.
That's a good point about central banks, and I think there's a price floor beneath. We can debate about the prices for what level the price floor is for gold and silver, but because central banks are now net buyers of gold and silver, and then you have also the central banks are monetizing their debt, they're printing more currency, they're devaluing all the currencies, that in my opinion has put basically a price floor beneath gold, silver, and also I think oil. And then the other commodities that you talked about, the food and agriculture, and I think also oil, are consumer staples, and you have that 7 billion population, and I don't see the population declining to 5 billion in the next 5 years, and I see the population at least staying flat and probably growing. So that's going to put a humongous supply constraints on food and oil and those types of things that people have to have. And that's why I like those commodities above, say, like base metals, which I think in terms of China, from what I've heard China's doing, they're just putting copper in warehouses. They're building a lot of buildings that are not necessarily needed right now, and then they're dumping coal in their harbors.
Yeah, I think when you look at the oil picture, this is probably one of the bright spots. As bearish as I am, and it would be a very dark version of bearish in terms of the U.S. economy and fiscal position at present. One of the brightest things that we have going for us is vast natural resources. We may not have the leadership today to unlock those resources, but that's okay. At some point, we will. And it's not as if everything in American future is predicated on the next 2 months in the fiscal cliff, or 2 years in the next midterm election, or 4 years in this particular administration. We will, at some point, unlock a lot of our natural resources. There's enough coal in the state of Montana to give Guar a run for its money in terms of natural resource reserves and energy reserves. To unlock that is a different question, of course, and how you begin to utilize it. But clearly, we've made great strides through improved technology and natural gas availability. That's been an outright revolution in the last 18 months. in terms of supply here in the United States, and very cheap supply. Ultimately, that will refuel and allow us to be, I think, in the same position we are, maybe to a slightly lesser degree, number one in terms of the world economy. We have some benefits coming, but they may be 3 to 5 to 7 years out.
Yeah, and I think the U.S., if the politicians got out of the way, if they stopped trying to intervene in the market, if they stopped trying to create more rules, more regulations, more direct taxes, the U.S. has all the things it needs to be a successful economy. We have tons of natural resources. We have great farmland. We grow most of the world's food, besides Argentina and Brazil. And we have all this oil, we have the shale deposits, and then what worries me then is the regulators. The only thing stopping all the shale from being exploited is going to be then all the market intervention, all the rules and regulations that could make shale uneconomic or just completely ban it.
Yeah, when you look at current output increases here in the United States, again, this is a positive in terms of sort of our economy. It's not going to be too long before we're exporting a good amount of oil from the United States. We've increased in the last 12 months by 7% in terms of total output. Over the last 2 years, 15%. And this is where you're not finding major oil patches the rest of the world over. There is less and less cheap oil out there, and yet we are finding some in our own backyard, which is long-term very positive for us. Not something that you can expect to see a positive rate of return on necessarily in the next 2 to 3 months, because as you rightly point out, we have major regulatory constraints and concerns in the immediate.
Exactly, David. And as we wrap up the interview here, please tell our listeners more about your weekly podcast and where they can contact you to get them to look into managing money for them, and also about your videos that you just put out, because I think those are great and must watch for our listeners.
Sure. Well, we're a multi-generational family business, and for 4 decades have served the institutional and retail customer for precious metals purchases, and we do that both here domestically as well as in Europe and in Asia. We have offices in Brussels and storage facilities all around the world for folks who want geographic diversification for their metals portfolios. That's one thing that we do. Our wealth management platform is quite different. It manages across assets, across currencies, across markets. And we've since inception run numbers between 12 and 14%. All of that's on our website and documented, I think, sufficiently there if someone's interested in getting to know us. We're really not people who anyone should ever consider working with unless there's sort of a shared worldview, concern about some of the macro picture, and a focus, on asset preservation, staying ahead of the real rate of inflation. These are some of the things that sort of define our course, and have helped us help other people over the last several years. McAlvany.com is kind of our main portal, if you will, McAlvany.com. And from there, you can find our wealth management website, you can find our precious metals website, and our weekly commentary. We provide each Wednesday a fresh audio commentary, and then every Friday on our wealth management website, an update on the markets and what we thought was the most important happenings of the week.
Great. And I just want to thank you again for coming on and giving us your time. That was a great interview, and hopefully we can have you back on soon for another podcast sooner than a year, over a year, which was what it took to record another one.
Sounds good. I look forward to it.